Hey guys, this is Dawson Discussions. I'm your host, Nathan Dawson Jr. Today's date is June 10th, 2021. In this episode, I will be talking about startup investing and how I think it can actually be an opportunity in order for the black community to build black wealth in the United States of America. So stay tuned. As a disclaimer, I do fully support a black economic empowerment plan for the Native non-Hispanic black American community because of the effects of slavery, Jim Crow, and the current political policy of benign neglect. In April 2019, former President Donald J. Trump signed Executive Order 13872, an executive order for the Economic Empowerment Plan for Asian Americans and Pacific Islanders. Because of the political policy of benign neglect being used against the Native non-Hispanic Black American community, I'm pretty sure that a similar legislation or an executive order similar to Executive Order 13872 just for the Native non-Hispanic Black Americans will not happen in the near future. So essentially this video is a self-help to build black wealth and then for us to use that wealth to lobby to get a bill or executive order similar to Executive Order 13872, but instead of it being for Asian Americans, again, it's going to be actually for the Native non-Hispanic Black American community. So stay tuned. Okay, essentially a startup or an emerging company or early stage company is essentially a company or project undertaken by an entrepreneur in order to seek, develop, and validate a scalable business model. Well, while entrepreneurship refers to all new businesses, including self-employment and businesses that never intend to become registered, startups actually refer to new businesses that intend to grow large beyond the solo founder. So one of the startups' first tasks is raising a substantial amount of money to further develop the product. And in order to do that, they have to make a strong argument, if not a prototype, that supports their claim that their idea is truly new or a great improvement to something on the market. So startups typically begin by a founder, which is the solo founder, or co-founders who have a way to solve a problem. The startup process can take a very long period of time, by some estimates 3 years or longer, and hence sustaining effort is required. But over the long term, sustaining effort is especially challenging because of the high failure rates and uncertain outcomes of that startup. The failure rate of a startup company is very high. According to a 2014 article in Fortune, estimated that 90% of startups ultimately fail. An example of 101 unsuccessful startups, the top 5 factors in failure were lack of consumer interest in the product or service, which is 42% of the failures, funding or cash problems, which is 29%, personnel or staffing problems, which was 23%, competition from rival companies, which was 19%, and problems with pricing of the product or service, which was 18%. More than one factor can be cited as a cause for failure, so these numbers add up to more than 100%. So in the early stages, startup companies have little or no revenue coming in. They have an idea that they have to develop, test, and market. That takes considerable money, and startup owners have several potential sources to tap. So why invest in startups? Well, startup investing is the action of making an investment in an early stage company. Beyond founders' own contributions, some startups raise additional investment at some of the several stages of their growth. Not all startups trying to raise investments are successful in their fundraising. Essentially, investing in a startup was historically reserved just for the uber wealthy and those with very strong venture capital or angel investment connections and networks. As a result, less than 0.1% of the U.S. currently invests in startup companies. Of course, it is exciting because of the passion that drives the founding team, because it's a great opportunity in a market you're familiar with, or even because it is a simple, scalable solution to a problem. But with the passed Jobs Act and the emergence of equity crowdfunding platforms, investors are now able to access to a broad assortment of early stage investment opportunities. Investors are generally more attracted to those new companies distinguished by their strong co-founding team, a balanced risk-reward profile, in which high risk due to the untested disruptive innovations is balanced out by high potential returns and scalability, which is the likelihood that a startup can expand its operations by serving more markets and more customers. So startups have several options for funding. So venture capital firms and angel investors may help startup companies begin operations, exchanging the seed money for an equity stake in the firm. So your venture capital, usually abbreviated as VC, is a form of private equity financing that is provided by venture capital firms or funds to startups. So in early stage and emerging companies that have been deemed to have high growth potential or have demonstrated high growth in terms of number of employees, annual revenue, scale of operations, and etc. So essentially, these venture capital firms or funds invest in these early stage companies in exchange for equity or an ownership stake. Venture capitalists take on the risk of financing risky startups in the hopes that some of the firms they support will become successful. Because startups face high uncertainty, VC's investments have high rates of failure. The startups are usually based on an innovative technology or business model, and they are usually from the high technology industry, such as information technology, probably know it as IT, clean technology, or even biotechnology. Venture capital is attractive for new companies with limited operating history that are too small to raise capital in the public markets and have not reached the point where they are able to secure a bank loan or complete a debt offering. In exchange for the high risk that venture capitalists assume by investing in smaller early stage companies, venture capitalists usually get significant control over company decisions in addition to a significant portion of the company's ownership and consequently their value. Angel investors. Essentially, angel investors an angel investor is an individual who provide capital for a business startup, usually in exchange for convertible debt or ownership equity. Angel investors usually give support to startups at the initial moments, where risk of the startups failing are relatively high, and when most investors are not prepared to back them. The application of the term angel originally comes from a Broadway theater, where it was used to describe wealthy individuals who provided money for theatrical productions that would otherwise had to shut down. So in the year 1978, William Wetzel, a then professor at the University of New Hampshire and founder of its Center for Venture Research, completed a pioneering study on how entrepreneurs raise seed capital in the United States. He began using the term angel to describe the investors who supported them. A similar term, patron, is commonly used in arts. And angel investors are usually retired entrepreneurs or business executives who may be interested in angel investing for reasons that go beyond pure monetary return. These include wanting to keep abreast of current developments in a particular business arena, mentoring another generation of entrepreneurs, and making use of their experience and networks on a less than full-time basis. But because these innovations tend to be produced by outsiders and founders in the startups, rather than existing organizations, angel investors provide, in addition to funds, feedback, advice, and contacts. Because there are no public exchanges listing on their securities, private companies meet angel investors in several ways, including referrals from the investors' trusted sources and other business contacts, at investor conferences and symposiums, and at meetings organized by groups of angels where the companies pitch directly to the investor in face-to-face meetings. So in the United States, these angels are usually accredited investors in order to comply with the current SEC regulations, although the Jobs Act of 2012 loosened those requirements starting January 2013. So Robert Herjavec, Kevin O'Leary, Mark Cuban, Damon John, and Laurie Greener are examples of angel investors. Of course, you probably might know of them from the TV show Shark Tank. Equity crowdfunding is the online offering of private company securities to a group of people for investment, and therefore it is a part of the capital market. Because equity crowdfunding involves investment into a commercial enterprise, it is often subject to securities and financial regulation. Equity crowdfunding is also referred to crowd investing, investment crowdfunding, or crowd equity. Equity crowdfunding is a mechanism that enables broad groups of investors to fund startup companies and small businesses in return for equity. Investors give money to a business and receive ownership of a small piece of that business. If the business succeeds, then its value goes up, as well as the value of a share in that business. The converse is also true. Coverage of equity crowdfunding indicates that its potential is greatest when the startup business that are seeking smaller investments to achieve establishment, while follow-on funding required for subsequent growth may come from other sources. Given that this is a very new asset class for most investors, and by most investors I'm actually mean the retail investor, I would recommend for some retail investors to allocate some of their capital into these equity crowdfunding opportunities. So for one, overall portfolio diversification. Me personally, I would never advise putting a large percent of your capital into early stage investments because it's simply not prudent. However, allocating at least 5% and up to 15% if you want to have a little skin in the game, which means if you're just slightly more of a risk taker, can actually increase returns while lowering volatility. This is because early stage private companies generally have a low correlation with the traditional asset classes, such as the public stocks and public bonds. A shares post white paper concluded that allocating at least 5% to private growth companies could increase the returns of a traditional portfolio by 12%. And of course, 12%, that is usually the highest that the stock market can actually return, and not including inflation, because of course the stock market generally is 10 to 12%, but then again with inflation 2 to 3% drops it down to 7% to 9%, but 12% is usually the highest, I think. Most sophisticated pensions and endowments have also come to the conclusion that allocating a portion of their overall portfolio to venture and private equity investments can reduce risk while increasing returns. For example, Yale University's endowment allocated 31% of its portfolio to venture capital and private equity in 2013 and had generated 29.9% annualized returns in private equity and venture capital since 1973. That number, 29.9%, actually rivals the returns that Peter Lynch when he took the helm for the Magellan Fund, because Peter Lynch, I think he averaged 29.2%, but Yale, when they actually allocated 31%, they actually generated 29.9%. So that's actually kind of impressive. So the Yale Endowment's 2013 annual reports defends its asset allocation model, noting that traditional 60% equity, 40% bond portfolios are not diversified, not equity oriented, and not appropriate for long-term investors. Along the same lines, the Deutsche Asset and Wealth Management report argues that adding alternative assets to a portfolio of stocks and bonds can reduce volatility and increase portfolio efficiency. Okay, so number 2, reaps the benefits of getting in early. So the aggregated returns for the asset class as a whole are better than you might expect. So in 2012, Thomson Reuters launched the Thomson Reuters Venture Capital Research Index, which seeks to replicate the performance of the venture capital industry. The index shows that the venture capital has returned 19.7% per year since 1996, versus just 7.5% and 5.9% respectively for public equities and bonds. Also in 2012, Professor Robert Wiltbank released findings from the largest data set on individual angel investments that has ever been collected, and found that U.S. angel investors return 2.6 times their money on average. If we assume that the average time to exit an angel investment is 5 years, 2.6 times equates to 21.1% annual returns, which is slightly higher than overall venture returns. Also, there are few asset classes that offer the home run potential of venture investments. Peter Thiel's initial investment in Facebook increased in value by over 2,300 times, as in 2,300 times prior to its IPO. Although investors should absolutely not expect to find the next Facebook, the next Twitter, the next Uber, the next Netflix, or the next Amazon, it's hard to ignore those asset class potential to generate outsized return. Investing in startups may come with inherent risk, but the low requirement for overhead capital combined with the high upside potential potentially makes for a winning combination if it is done well. Number 3, become an integral part of a team that needs you. So, investors of startups and smaller firms tend to take on more active roles in advisory and management than those of more established or publicly traded companies. In part, that's simply because getting in early gives you a higher proportion of voting shares, and by the same token, influence over the direction your company takes. Another reason, though, is due to a legitimate need of many companies and entrepreneurs for mentorship, industry connections, strategic management, and etc., which go far beyond simply providing funding. Investing in a startup will give you a voice and a position to be an integral part of the most consequential decisions the company will make in the future. Number 4, start innovating again with fresh and ambitious entrepreneurs. The entrepreneurial spirit rarely leaves a person once it settles in, and any aspiring or former entrepreneur can attest that there will always be a need to strategize, to problem solve, and to create. If you're a potential investor who is looking for a way to experience the thrills of running a startup, collaborating with other entrepreneurs to provide your own unique insights and opinions, then providing funding next to advice can prove to be a great way to do such a thing. Number 5, detach yourself from market trends by diversifying. It is well known that continued diversification of your portfolio improves its overall performance, and introducing private equity and venture capital into the mix is a powerful method to do so. The performance of startups is less likely to be affected by macro level and market shifts, in part due to their ability to pivot, and so there is often little correlation between early stage private companies and the behavior of the overall market. Hence, keeping at least a small portion of your portfolio in startups can help reduce the risk while increasing returns. Number 6, use your investments to bring some good into the world. Investing in startups can yield more intangible benefits as well, specifically for socially conscious investors. Startups are, of course, on the edge of problem solving and innovation, fueling the discovery and popularizing of life-changing solutions that larger firms were unable to envision or bring to market. As an investor, you can have a serious impact on the success of those products and services which benefit the lives of consumers or produce positive results for the society at large. There are few other ways to create such a profound impact in the lives of others while also acting in your own rational self-interest. And lastly, number 7, create more jobs through your investments. A surprisingly high number of jobs created comes from companies that are less than 5 years old. In fact, the U.S. new firms have created a net average of 3 million jobs while existing firms lose 1 million annually. Getting involved in startups puts you in place to support this tried and true method of job creation, once again producing positive results to benefit the countries your startups operate and as you diversify your personal portfolio. Of course, we have a saying in the U.S. that small businesses are actually the engine to the U.S. Economy. Okay, how do you make money in this investment? Well, for one, you can actually get it through an initial public offering or an IPO. This refers to the process of offering shares of a private corporation, in this case, the startup that you invested, to the public in a new stock issuance. Public shares issuance allows a company to raise capital from public investors. The transition from a private to a public company can be an important time for private investors to fully realize the gains from their investment, as it typically includes share premiums for current private investors. Meanwhile, it also allows public investors to participate in the offering. Companies must meet requirements by exchanges and the Securities and Exchange Commission, SEC, to hold an IPO. IPOs provide companies with an opportunity to obtain capital by offering shares through the primary market. Companies hire investment banks to gauge demand, set the IPO price, the date, and more. An IPO can be seen as an exit strategy for the company's founders and early investors, realizing the full profit from their private investment. For example, just like how I said earlier, Peter Thiel's initial investment in Facebook increased in value by over 2,300 times prior to its IPO. And of course, with an IPO, an IPO is kind of what most private investors would hope for because they actually go public. But then again, the high failure rate with startups is kind of very hard for your startup company to go public. But the second way is through mergers and acquisitions. So, with mergers and acquisitions, or M&As, is a general term that describes the consolidation of companies or assets through various types of financial transactions, including mergers, acquisitions, consolidations, tender offers, purchase of assets, and management acquisitions. So, for example, Facebook merged and acquired. Well, Facebook actually acquired Instagram. So essentially, if you were an early investor of Instagram, and once Facebook acquired Instagram, then those early investors in Instagram, they actually made a pretty sizable profit. Of course, it's probably not going to be that high as an IPO, but their early investors, they actually made quite a sizable profit through Instagram being bought out by Facebook. So, what is the best case scenario when it comes to startup investing? Again, just like how I alluded to earlier, the aggregate return for the asset class as a whole are better than you might expect, because venture capital has returned 19.7% per year since 1996 versus the 7.5% and 5.9% through respectively through public equities and bonds. And of course, just like how I said earlier with Peter Thiel, when he invested into Facebook before its IPO, he actually made up to 2,300 times or 2,300 times his money prior to the IPO. So, what's the worst case scenario that can actually happen when you invest in a startup? Well, you can actually lose your entire investment. Versus a publicly traded company, like on a stock market, you could just sell your shares and then like whatever the underlying dollar amount you can actually get. But with a startup investing, you can actually lose your whole entire investment. Over the long term, sustaining effort is especially challenging because of the high failure rates and uncertain outcomes. That's just the reality of investing in startups, and when they fail, you're just going to lose your money. The failure rate of startup companies is very high. Again, it was like 90% of them usually fail. But those 10%, if you can actually invest in the 10%, and then even more so when they get acquired or merged, or even better, IPO, you're going to make a whole lot of money. Again, just like I was saying with Peter Thiel, when he was an early investor with Facebook, he actually made 2,300 times or 2,300 times the amount of money that he actually placed in it. Okay, how much money do you need to get started? The lowest that I've seen and that I've also heard, it was $10. $10 is usually the lowest. $10 to $100 per opportunity for the lowest. Of course, you might need like maybe 200, but the lowest $10 and 100 at least for the online websites, which I'm actually going to get to in a little bit. When should you invest? So essentially, you want to make sure that you have adequate income. If you work a 9 to 5, then yeah, you can also invest in a 9 to 5. I mean, not invest in a 9 to 5. Work at 9 to 5, and then you can actually get your paycheck. Then, of course, you budget your personally insured life, health, auto, renters, and homeowners insurance. You want to take care of your high interest debt. Have a fully funded emergency fund, and then you actually want to have liquid investments before you actually jump into startup investing, because startup investing is actually illiquid. So, how much should you have in your portfolio? It depends on your risk tolerance and your personal and your researching. I would. It's generally the rule of thumb is usually at least 5% if you want to invest. 10% is usually max, maybe 15% if you want to have a little bit of skin in the game, which means you want to be a little bit more riskier than usual. Okay, how to value a startup. It's very similar to the fundamental or the quality analysis of a public company or like a stock, except for that dividends are not taken into account for obvious reasons. Okay, 1. Sound business model. A company with a clear focus has a better chance of reaching this goal. When a company is run simply, there's not much to draw the eye. However, it means that the business is more likely to be stable and have a good growth curve behind it. This is simple. This is because a simple business model does not require a lot of learning in order to implement. So essentially what I mean by this is Does the business solve a problem? Is the business model simple for you to understand? How does the startup make or intend to make money? How much can it actually make? So number 2, superior management. An effective management team is crucial to the success of a business. The decisions of a company are made by management. So any misuse of your funds is going to affect your investor. It will affect of investors and your fellow investors. So an experienced management team has the best chance to lead a company into a prosperous future because these startup companies that are classified as growth companies are focused on increasing the profits and sales of the organization. The management team is going to have to matter a lot. As a investor, especially as a private investor, private equity crowdfunding investor, you're entrusting your capital to the care of the management team of that startup that you're investing in. So their decisions on strategy, capital allocation, pricing, cost structure, etc., affects the amount of free cash flow the company will earn. So from the 2017 Berkshire letter, betting on people can sometimes be more certain than betting on physical assets. So beyond the founders, does the team have the right people in the appropriate roles, including experienced advisors? Does the company have a management of unquestionable integrity? Keyword is unquestionable. Management team that has any history of dishonesty, fraud, ignoring shareholders' interests will likely repeat this behavior, and you don't want to be in their way when they do. Does the management talk freely to investors about its affairs when things are going well, but clam up when troubles and disappointments occur? Is the management forthcoming about mistakes they've made, or is everything sugarcoated or blamed on the economy, weather, the markets, or the customers? If management takes ownership for the company's underperformance and thoroughly explains the steps that they're taking to improve the business, you probably might have found a winner. Number 3, significant market share. When a majority of individuals rely upon the products of a company, chances are that the company has a good insight into consumer preferences. So, what is the product or service that the startup is providing? If the company produces a consumer product, investors can actually read online reviews of the product to judge how consumers view the company's product or service. If you're researching a soon-to-be brick-and-mortar retailer, then you should eventually ask people who have visited their stores and say, like, okay, you can actually get their insight. And of course, if it's a restaurant chain, then you should try to eat at the restaurant. If you're researching a software company, you should try to use their software and then base your opinion off of that. An investor should research how the company's product or service compares to the competition and how it's viewed by customers. And number 2, brand loyalty. How do consumers perceive the brand? Companies with a valuable brand don't need to fight as hard to attract customers back to their business for repeat purchases. And repeat purchases create a steady stream of recurring revenue. So essentially is considering the significant market share, you have to think if you're a startup that you want to invest, how do you think people would perceive the quality of the product or the service, or how do you think if they're going to be loyal to the brand? Number 4, competitive advantages. So a company that is ahead of the pack will often be on the top of the cutting edge trends and industry changes in areas like marketing and technology. You want to single out those companies that are and likely to stay at least one step ahead of the competition. This is called a competitive moat, coined by Warren E. Buffett. The unique, sustainable competitive advantage that keeps competitors away and allow a company to generate higher than average profits. The wider the moat, the longer a company's financial success should last. Within any given industry, companies are constantly trying to take market share from each other. For a company to avoid ceding market share to its competitors, the company needs to have a strong competitive advantage. For example, it could come in a form of a product or service that is difficult to replicate. Think of the Coca-Cola recipe. I don't think nobody really knows the Coca-Cola recipe. And plus, I think it's probably patented, so it's kind of safe to say that the Coca-Cola Corporation, they have a wide moat. So it's kind of hard for, say, Pepsi to actually literally duplicate Coca-Cola, or at least the Coca-Cola recipe, and then try to make Coca-Cola, trying to make Coca-Cola lose their footing in the market. Yeah, in the market. Another example would be a cost structure that is superior to peers. So Walmart, they have this mode because Walmart, I think they be having like the rollbacks, and then they be having like a very, very, very low cost. I think and of course Walmart, they compete with Target. So I think Walmart might be cheaper than Target, or they kind of might be neck and neck. But I think Walmart, they do have that competitive advantage over Target. Another one would be a brand image that is superior to peers. Of course, many people, they have Apple. Of course, Apple versus Samsung. There's that rivalry. Me personally, I have Samsung because I like Android, but still, many people, they have a an Apple product, either iPod, iPhone. Um, well, I don't know too much about Apple because I don't use a whole lot of Apple products. I use Android products, but just to give you a example, you also have high switching costs. That would be an inconvenience for a competitor, for a customer to pay to switch over to that company's competitors. Again, just like Apple, if you have an iPhone, chances are you probably have an iPod, or like an iPhone, iPod, and MacBook Pro. But for you to actually switch over to, say, Microsoft, like the Microsoft products, then it's probably going to be a inconvenience for you to pay the cancellation fee, and then you have to switch over to Microsoft, and then vice versa. Another example of a competitive advantage would be the network effect. Google, they own YouTube. It began with only a few videos, but as more users began posting videos and more users began searching for videos, YouTube grew exponentially, and has only seen this user base grow over time, and even to this day. Currently, there's really no real competition in sight for YouTube. And those are the examples of competitive advantages that you want to look for in a startup. Okay, number 5, new developments, or the focus into R&D. So the quality of human talent at a company is just as important as the quality of management team. So not every company will be the next Apple, the next Google, the next Uber, the next Lyft, the next Microsoft, the next Apple, the next Coca-Cola, or the next Netflix, or the next Amazon, or etc. But it's important for management teams to foster a culture of challenging the status quo, trying out new ideas, and embracing innovation. If a company places a high priority on its research and development team, it's likely that they will roll out a successful introduction. And then, of course, if the product takes off, then so will the image of the startup. For number 6, financial performance. A profitable company makes more money than it spends. Of course, we expect startups to be profitable simply by being a for-profit organization, but many survive for years by securing outside financing. So it's worth checking financial statements to look at profit margins. A great company generates a profit by charging more than enough to cover its costs. So with this, I don't think startups really do have quarterly reports, just like a public company do. But I think that there is a Form C that you can actually look into, which is kind of like a quarterly report, but it's kind of like the most up-to-date annual report, kind of sort of, for you to actually look. Then you'll be able to look at their balance sheet and then look at their income statement. So essentially, startups by definition, they don't have a long track record of revenue, earnings, or cash flow, if any. So much of the valuation exercise is conducted by looking at the marketplace of comparable companies and understanding how the industry for a type of startup values the companies within it, according to Georgine Huang, the CEO and co-founder of Fairy Godboss. And of course, when evaluating a company, some may take into consideration dividends, but these are actually startup companies or growth companies, so they can't really pay dividends because they don't have that cash flow, and of course, they're not public to do so for trying to pay out our dividends. So, of course, dividends that are non-applicable to startups. Okay, so how do you find these startups to invest in? One would be networking. joining professional angel networks or a unaccredited version of a angel network. Actually, what I mean by this, there's like a few websites. I'm going to link some in the description below. For example, you can go to Republic, WeFunder, Seed Invest, Microadventure, Mainvest, and Nextseed and Net Capital. Those are some examples, and again, I'm going to list the links below in the description box. Okay, what are some tips for investing in startups, or at least what I've looked up? So one, you want to value the company. Of course, you can't really value a startup like a stock similarly, because again, they don't have that track record. So you want to make sure that you understand the business model, make sure that it solves a problem, and enthusiastic management and co-founders, the potential to have significant market share, economic moats especially, and focus on research and development. Number two, you want to diversify across different sectors. I've seen offers for consumer tech, healthcare, transportation, and food and beverages, even video games, real estate, and also cryptocurrency. So you want to diversify across different sectors. Also, be aware that it's illiquid. It's safest to assume you cannot resell your investment to another investor, just like the stock market. First, there's not yet a liquid secondary market like the New York Stock Exchange for private companies just yet, unless somebody really do become bold and then create a private company New York Stock Exchange. Regulation crowdfunding also specifically prohibits the resale of securities for 1 year except to the issuer and a credit investor, a family member, or to their trust. Number four, you want to ask the founder and management questions. If you look at the business model and then something doesn't seem right, just ask questions in order to ease out your doubts about the company. And lastly, number five, review the terms of each deal carefully, including rights associated with the offered securities. You generally will not have the same rights as early investors or accredited investors, including voting and information rights. You just have to look at the terms because each deal is totally different on how they when it comes to private shareholder rights. So essentially, you want to invest in companies that you truly do believe. Invest in a startup because you love their mission, product, or service, but not just for the potential profit or return. Of course, former NBA player Shaquille O'Neal, he had an interview with Wall Street Journal in July 2019. He said that he heard that Jeff Bezos, know him as the CEO and chairman of Amazon.com Incorporated, said at one time he makes his investments based on if it's going to change people's lives. Once I started doing that strategy, I think I probably quadrupled what I'm worth. So essentially, it helps them decide what opportunities to jump on and which ones to pass up. Anil further then said, if something comes across my desk and I don't believe in it, I don't even look at it, even if it looks good on paper. In fact, he actually really focuses on the numbers. So he's also said, whenever I do business, it's not about the money. He also told CNBC's Bob Pisani in 2018, he said that I never say, if I invest in this 5 years down the line, we could sell it for this. Every time I had that model, it's always been a failure. So essentially, make sure you're investing in things that you believe in, as opposed to investing in things that other people believe in. PayPal Senior Vice President of International Markets, Rohan Mahadevan, said in an interview to CNBC, the CNBC show or segment was called Make It. He recommends testing a product or service before investing in it to better understand how the business operates. Of course, this brings me to Peter Lynch investment strategy, who I actually mentioned earlier about the 29% return. So essentially, Peter Lynch, he was the fund manager of the Magellan Fund at Fidelity Investments. Of course, Fidelity Investments. It's one of the big three that I call when it comes to the larger, more established, well-known brokerages. Of course, you have your Fidelity, you have your Charles Schwab, and then you have Vanguard. And of course, Vanguard is the most popular because I hear people say that they be investing in the VTSAX when it comes to the investing in the total stock market. And of course, Vanguard was founded by Jack Bogle. John Clifton or Jack Bogle, he created the index fund. So, of course, those three companies, the well-known larger companies that people invested in before these smaller companies like Robinhood and ML Finance and Webull, for stock investing. And then because, Robinhood, they introduced zero commissions for buying and selling stock, and then Fidelity, Charles Schwab, and then I think Vanguard, they did away with commissions. So anyway, between the year 1977 and 1990, Peter Lynch averaged a 29.2% annual return, consistently more than double the S&P 500 stock market index, and making it the best performing mutual fund in the world at that time. During his 13-year tenure, assets under management increased from $18 million to $14 billion. So $18 million with an M to $14 billion with a B. His most famous investment principle is invest in what you know, popularizing the economic concept of local knowledge, meaning since people tend to be more experts in certain fields, applying this basic invest in what you know principle helps individual investors or the retail investors like you and I, instead of the institutional investors like banks, insurance companies, hedge funds, etc. So for the retail investors, he popularized the local knowledge investing philosophy. So, for example, in his book, One Up on Wall Street, Peter Lynch explained how he invested in Dunkin' Donuts. Not after reading about it in the Wall Street Journal, but rather actually going to a local Dunkin' Donuts, and he ordered coffee, and he really enjoyed the coffee. And then, assuming others would similarly be impressed and noting that the company's Boston locations were always busy, he then studied the company's financial status and decided to invest in Dunkin' Donuts, which proved to be one of the best performing stocks that he had ever bought. Okay, is startup investing for you? Well, it all depends on your risk tolerance. If you are risk adverse, which means you don't want to take on a whole lot of risk, or if you don't want to take risk at all, then this type of investment is probably not for you. While some startups succeed and can bring substantial upside to investors, most will fail and you will lose your investment. Investments in startups, early stage ventures, and emerging technology companies are speculative, and these enterprises often fail. Unlike an investment in a mature business where the track record of revenue and income as compared to a publicly traded stock, the success of a startup, early age venture, or emerging technology company often relies on the development of a new product or service that may or may not find a market. So you should be prepared to lose your entire investment. That's just the reality of investing in a startup. If you do invest and then you lose your money. So what I'm trying to say next is don't be surprised if you don't lose your money. I mean, of course, kind of feel down if your company didn't make it, but at the same time, only invest the money that you're willing to lose. So if you do lose your money, then make sure that it was money that you didn't need. But of course, if you do invest your money and then your company then IPOs or it merges or it being acquired, then that's actually when you actually made a really good investment. So if you need to liquidate your investment between when you invest, when your investment is finalized, all the way up until even if it do IPOs or if it actually do M&A, then this type of investment is not for you. So your ability to resell your investment in the first year will be restricted with narrow exceptions. You may need to hold your investment for an indefinite period of time. Unlike investments in companies listed on a stock exchange where you can quickly easily trade your stocks, you may have to locate an interested private buyer to resell your crowdfunded investment. So it's quite illiquid. There's also limited disclosure. The company must disclose information about itself, its business plan, the offering, and its anticipated use of proceeds, and among other things. It's important to note that an early stage company may be able to provide only limited information about its business plans and operations because it's still developing its operations. The company is also only obligated to file information regarding its business annually, including financial statements. So again, the company is only obligated to file information regarding its business annually, including financial statements. But startups, they don't have that track record. But over time, because so when you invest in a startup, it's like you're here, and then it goes up, it goes up like this, and then up here, if it do survives, then it lists on the IPO, and then when it goes IPO, and then when it's on the stock market, then it'll just take off. So you'll be kind of like here, and then there's like not really a whole lot. So I think like when they do the offer, they probably have like maybe a few years of a few years of work, and then after that, they're probably like maybe the next like third or fourth year, they're going to start accepting investors, and it could probably take up to maybe 5, 6, 7 years before they be listed on the before they IPO. And of course, when they go public, then they get to release their quarterly statements, and then they'll be able to, and then you'll be able to more value a company that way. But valuing a startup in the early stage, when it's like here, and then when it's, like that's kind of difficult because a startup is like a private company, and you can't really value a startup because it's new and then it's a private company. But yeah, the financial statements is kind of difficult, but you just have to like go based off the qualitative, not really the quantitative. Or I probably got the words mixed up, but you actually want to go like with the business model, market share potential, and R&D potential, and then like that. And also, lastly, you want to go for the lack of professional guidance. Many startup companies partially attribute their early success to the guidance of professional early-stage investors, angel investors, and venture capital firms. These investors often negotiate for seats on a company board of directors and play an important role in providing additional resources, context, and experience in assisting early-stage companies and executing on their business plans. An early-stage company primarily financed through crowdfunding may not have the benefit of such professional investors. But if you're a very high-risk taker or speculator, you want to achieve a very high return, and you don't need the money you invested in the near or far future until it IPOs, or if it M&A merge and be acquired, then startup equity crowdfunding might appeal to you. For one, portfolio diversification. Again, I wouldn't recommend having 20-25% of your capital in a startup. I would probably say at least 5%, up to 10% max, or 15% if you want to get a little bit of skin in the game, meaning you want to be a little bit more aggressive. But bare minimum 5%, you should be quite successful, and to have your overall portfolio diversified. Again, number two, the return. I mean, Peter Thiel, when he invested in Facebook before his IPO, he made 2,300 times or 2,300 times his return on capital. And of course, number three, be part of a team that probably might need your money. And then when they take off, then so does your profit. And then number four, start innovating again with fresh and ambitious entrepreneurs. I mean, if you're into that entrepreneurial spirit, and then if you want to help your fellow entrepreneurs also succeed, then startup investing just might be for you. Number five, again with the diversification, it's not correlated to the stock market. So the stock market could actually be having its may have a terrible season, but your private investment, it's not listed on the stock market, so they're not really affected by the overall behavior of the stock market or bond market. And of course, you can use your investments to bring some good into the world. If it brings good to the world, and then if you invest in it, and then when it takes off, and then it IPOs, you can probably say that you did some good in the world. Of course, number seven, you also a job creator. I mean, like, how many job creators do you know personally, or at least besides Wall Street? Like with them creating jobs or the government. So if you invest in a private company, and then when they take off, then new firms, they create 3 million jobs. So, but the existing firms like those on the stock exchange who've been around for a while, they be losing millions annually, whether through automation, outsourcing, or laying off, just like with this current pandemic. But we're recovering from the pandemic. Okay, why and what am I investing in? So why am I investing in equity crowdfunding deals? So essentially, the idea hit me from, again, how I said earlier, the Shark Tank TV show on CNBC, and to diversify my portfolio away from the traditional public stock market and access a new world of investing. Despite the high risk and high failure rate, yes, I am a startup and equity crowdfunding investor, or a private equity investor, which is why I'm doing this video, or at least I'm kind of sort of sound like I'm speaking good about private equity startup crowdfunding investing. Of course, I'm not a traditional angel investor or traditional venture capitalist in a traditional sense, because I'm not a retired CEO of a public company or even a private company that never went public. And of course, I'm not a chairman of a publicly traded corporation. So that's why I'm actually do like to take private equity crowdfunding. Even though it's very high risk, I'm quite a risk taker, because of course I don't have a whole lot of capital, and then I'm trying to 10, 20x my money outside of the stock market. Of course, the stock market, maximizes to 10%, but inflation, 10 to 12%, but inflation is 7 to 9%. But of course, I want to maximize my money. Of course, I know it's not all about the money, because again, startups do fail, but I still want to make that impact. And of course, the money that'll come later down the road. So, Okay, what am I investing in? As of this recording, I'm investing in 2 companies. One of them is called Dollaride, and again, I'm gonna list the links to the companies that I invest in. These 2 companies, they're not accepting any more investors, but I'm actually going to leave a link to the companies, so you can actually learn more about these companies, and then eventually when they go public, and you can say, oh, I heard about that company through some guy on YouTube. Okay. Dollaride. So as cities grow, more and more people are getting pushed farther away from the city center, but public transit is not keeping up. In New York alone, over 60,000 residents live in areas with poor access to public transit. This means that some people commute to up to 3.5 hours a day. This brings additional stress, hardship, and expenses to thousands of communities. So, founded in December 2016, Dollaride offers a new twist on an old transportation model that ensures that marginalized outer city communities have a faster, more convenient commute. Dollaride is making public transit available to anyone, anywhere, by delivering superior transportation starting at only $2 a ride. They do it by merging technology with the informal network of local commuter vans drivers, well, they call them dollar vans, to meet the growing demand for mobility solutions in transit deserts. So what I noted was this is actually a transportation business. Of course, the problem is, the transit deserts, as I explained a few moments ago. But one of the key things that you want to look for in investing is to look for an economic moat. And I found that economic moat. They offer only $2 a ride. Uber cannot beat that. Lyft cannot beat that. Damn sure the city taxi cannot beat that. And of course, it's faster than a bus. Another economic moat. So the growth. I think I did hear that the founder, his name is Sue Sani. He's a Nigerian American descent. He wanted to do a high speed rail. I don't think I've heard Uber saying that they wanted to do a high speed rail. I don't watch a whole lot of TV, but I don't think they're probably doing a high speed rail. Lyft, they're probably not going to do a high speed rail. But Sue Sani, CEO of Dollaride, he wants to do a high speed rail. So that's an economic moat. Again, I'm going to list the link to the company in the description. The second company I'm investing in is a company called Choose Health, founded in 2019. So the market for at-home lab testing is growing exponentially. The D2C lab testing market grew at 53% CAGR in 2009, 300 mm in 2019, 53% CAGR. So due to this pandemic, the COVID-19 pandemic is fueling this transformation further with patients now want to go to a clinic to get their blood drawn and tested. So they have remote and home lab testing, which is the future of this industry. So by helping individuals get easier access to their key markers of internal health and improving health literacy, the company is beginning to empower people to take a more active role in managing their health. So there's a systematic issue in the U.S., sick care versus healthcare. So Choose Health, a personalized at-home health tracking service that provides actionable insights. So essentially, they have all their tests and insights are backed by latest scientific and clinical research, and their team of doctors and researchers have compiled a personalized biomarker selection process that you can test from the comfort of your home. And their kits are uniquely positioned to offer personalized testing, allowing their customers fully customize their need for their health concerns and clinical insights backed by science to educate users on how to best manage and optimize their own health and lifestyle. And those, another thing before I close out the video, I actually want to show you the test that Choose Health has actually sent me. Okay, and this is the Choose Health box that you're going to receive in the mail if you are a customer. But since I was an early investor, I actually got one for free. So the box looks something like this. Choose Health. And of course, in it, they have the blood sample return bag, which is this. They have the instructions here. So, have it here. You can actually pause the video and read it if you can. Looks something like this. And you have the kit, and then you have a waist measure, so you can actually track like how big your waist is. So yeah, that's the Choose Health. Again, Choose Health. It's a company that I'm investing in. Hope it takes off in order to solve a problem, which I explained earlier with the business model and why they started it. And of course, because to try to make a difference in the world through my money. And of course, all those investments, those are all my investments I have at the time of this recording. And of course, I put down $100 each. So $100. If it fails for both companies, I only lose $100. But if it takes off, that $100 each from one, if one or the other takes off, then $100 times, using Peter Thiel's investment, probably return like thousands. Kind of incredible. I mean, it's kind of insane, but again, this is like the very most aggressive asset class that you can actually jump into. Very aggressive, but you got to play it right. Again, I'm going to leave the links to where you can actually find deals and the companies that I'm investing in. And again, this is Dawson Discussions. I'm your host, Nathan L. Dawson Jr., and I will see you in the next episode or next video. Take care and have a nice day.